In this video, I'm going to show you how the informed have been avoiding paying taxes and investing in real estate over the past 5 years. Notice I didn't say how the wealthy are doing this, because you don't have to be wealthy to do this. This is basically a cheat code used by everyday people who learned how to do these things, and I'm going to share them with you today in this video. So let me transition to my iPad here and kind of walk you through this, all right? So this strategy involves high income earners investing in real estate and leveraging a few strategies. This is the short-term rental loophole, combined with cost segregation studies, combined with bonus depreciations, the trifecta, if you will, okay? So let me take you through this, okay? We have, typically who's doing this is high income earners. Whom is a high income earner? I'm saying it could be a small business owner, a physician, someone in the technology space, but anyone who has either a W-2 job that's pretty high paying and or maybe a business owner that's, leveraged their business and is making a ton of money. What I mean by a ton of money? Well, you see the tax brackets here? Typically, you're going to be anywhere between the 32 and 37% tax bracket if you're single making $200,000 or more, or if you're married filing jointly making $400,000 or more, all right? So I'm saying if you're married filing jointly, it could be you and your spouse together making this amount, all right? So if you were in these scenarios, right, making 200 grand or more or 400 grand or more as married filing jointly, you're probably gonna owe between $80,000 and $100,000 in just federal income tax. That's not Social Security and Medicare tax, it's not property tax, it's not sales tax, that's not state income tax. That's just federal income tax, right? It sucks. If you do the math on that, it's about 25% or so, right? And so, you could live a nice life doing that, right? Earning 200 grand a year as a single person or 400K plus as a married filing jointly, taxpayer. You could lay back, go on your 1 or 2 vacations a year, enjoy your life, have a nice cars, whatever, invest in some sort of index fund, earning 8% for the rest of your life and become a millionaire. You could do that. No one would, say anything bad if you did that. However, this is what sort of the informed are doing. What they do is as follows. As you can imagine, this involves real estate. I believe I mentioned that at the top of the video. So you can go buy a piece of real estate. In this case, I'm saying $750,000 property, right? I know that's quite high. I'm talking nationwide. This is a lot of money. Okay, if you're living in California, maybe you think this is cheap, but nationwide, this is a lot of money. $750,000. You're gonna have to put down between 10 and 20%. I know some of you are like, "Hey, Navi, what do you mean 10%? Blah 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 blah." I get it. Some of you might not be able to get 10%. Let's go 20%. All right, but there are loan programs out there where you can get into a property for 10%. So in order to do that, if you put 20% down on 750,000, you have to put $150,000 down, right? That's your investment in the property. So let's do the math here. So what happens is when you buy rental real estate, you have to deduct the land value. So let's just, assume this is like a 0 lot line property with not a lot of land value. So the actual value of the building, right, the property itself, is $700,000. Now, normally, you can invest in this property, put a tenant in here, and have passive income, right? And if you did it that way, you would typically depreciate that $700,000 over the course of 27 and a half years. That's what the IRS tells us to do. And so you'd be getting a depreciation expense of $25,000 every year, approximately. That's not the exact math. That's approximately, okay? And again, there's people that do that and they make money on that, and that's fine. But what you could do is take that a step further. So what the informed have been doing over the past 5 years, they've been doing what's called cost segregation studies. So what this does is this has, sort of a specialist might come out to your property and say, "Hey, this value of this property is not $750,000. Or to say that another way, yes, the property is worth $750,000, but there's different components within that property that are not going to last the 27 and a half years, right? Let's say the driveway, I don't know, the mailbox, the HVAC system, all these different components are going to last a shorter period of time. And so instead of depreciating $700,000 equally over 27 and a half years, it's going to break up the $700,000 into different components, okay? And so these different components are going to have, instead of a 27.5-year tax life, they might have a 5-year or 15-year tax life. And when you couple that with bonus depreciation, again, that's sort of the third strategy that makes this all happen, is you're now able to depreciate all of that property over, in the year one. Okay, so in this example, I'm saying, hey, an estimate here might be $700,000. You might have $140,000 of depreciation to take in year one instead of $25,000. And then in years 2+, you might depreciate $21,000 a year. Okay, still not bad. So what does this do? Well, you have $115,000 more in depreciation in year one. So when you multiply that times the highest tax bracket, like 37%, right? That could be between Fed and state, right? You could be 32 Fed, 5 at state, and be 37. That's a tax savings of $42,500. So some of you might be like, well, where am I getting this $150,000 down from? Well, you're getting it from your tax savings. That's where some of the money's coming from. Keep in mind, there's other things happening behind the scenes here too, right? This $150,000 that they put down on this property, well, they're attempting with, you got to do something I forgot to mention is you got to have a short-term rental to do this, right? So you're not doing long-term rentals anymore. You're doing short-term rentals, right? Airbnb type of stuff. So your average stay is like 7 days or less. You're earning a 10 to 20% on your $150,000 that you put down as a payment. So that's another $15,000 to $30,000 a year. Okay. So you know what's happened to real estate prices, right? So you put 150 grand down, you're making 10 to 20% return. If you're running your Airbnb properly, you're probably making 15 to 20% cash on cash return. So you're making that money on the 150 grand you put down. You got a $42,000 tax savings. Your home appreciated by like double if you bought this thing, 4, 5, 3, even 2 years ago. It's just the perfect world, right? And so there's there's already many millionaires who've basically done this process over and over, rinse and repeat, work with specialty lenders who understand it, and have become wealthy, if not millionaires, over that period of time. All right. So let me know in the comments what you think. For those of you that are watching one of my videos for the first time, my name is Navi Miraj, and I'm a CPA who usually teaches, small business entrepreneurs how to save money in taxes, usually thousands of dollars in taxes. I do that via social media, but I also do that via a course I created that teaches all the strategies that I teach to my clients to you. All right, so you can check that out on my website, which is navimuradcpa.com. And don't forget to subscribe, share, or maybe even like this video. And maybe if you're watching on YouTube, check out these other videos. I'll see you either in those videos or in the course.